This is Mike Reed with cEntellect. Welcome to this week's proprietary research and analysis. This week is actually a hot topic. It's the marine IMO 2020 desulphurization economics. This is a hot topic. This is probably second only to Iran sanctions right now in terms of popularity of views on what's going to happen. Starting in 2020, ocean-going vessels of all shapes and sizes are going to have to reduce sulfur on high sulfur fuel oil from current 3.5% all the way down to 0.5%. So that's a huge reduction for these ships. These ships really have three ways to do it. They can burn low sulfur fuel, they can switch to LNG, or they can install scrubbers on the ships themselves, on the flues. I think scrubbers and LNG is going to make up less than 20% of the market. I think the solution with 80% of the market is going to be desulfurized fuels. Now, the reason this is such a hot topic is we don't know what's going to happen. There's two extreme views on this topic. The first view says this is going to be nothing more than a speed bump. The markets will equilibrate quickly and solve the desulfurization problem. The other view is the extreme, saying no, we could have world economic collapse and $200 a barrel crude oil. So you get extreme views on this topic, which is why it's so popular. I'm going to walk through 5 takeaways and then show you how I got there on this topic. The first is, I think it's really doubtful we're going to have 100% compliance on day one. I'm looking for compliance on day one to follow the 80-20 rule with 80% compliance on day one, and we're going to rise to 95% compliance by 2024. I think there'll be some waivers of penalties associated with non-compliance in the early year or years that makes this plausible. The second is, don't you think if it's more than a speed bump, don't you think if the world is facing economic collapse and $200 per barrel oil, I think the IMO would probably waive the regulations, reset them to a less onerous level, or push them back to a later date, or some combination of all three. So I don't really think it's going to be a harsh outcome. The third reason is refineries today are actively installing desulphurization. Now the question is, can they install enough to be fully compliant on 2020? The answer is no. Is the current rate of installation by 2024 to be fully compliant? Yeah, that's the current tracking when we look at these projects relative to total market demand for 100% compliance. The reason that they're doing this is if you look at a reasonable set of economics I'm going to walk you through, you could argue that on average these are 57% IRR desulfurization projects. That's a big number. That's why they're doing it. The fourth reason is I don't think this event is going to have anything to do with soaring crude prices. I think it's going to have a lot to do with crashing feedstock prices. I think what's going to happen is the high sulfur fuel oil that can't find its way into the shipping market is going to come to the U.S. refineries. Why the U.S.? We really have the only refineries at scale that are complex enough to run high sulfur fuel oil as a feedstock. The sulfur ends up in either petroleum coke or asphalt. And what's going to happen with this crashed feedstock prices? I look for crack spreads on U.S. refineries to be particularly healthy. These refineries are primarily in the Gulf Coast. And then the fifth takeaway is starting in 2024, I look for the sulfur spreads between high and low sulfur to kind of equilibrate. Keep in mind, high sulfur will still be used in some markets, including power generation, who do have scrubbers. But I think that spread's going to equilibrate to about $3 a barrel versus the current 50 to 60 cents a barrel. Now let's walk through how we came up with these takeaways. The first thing I want to do is I want to look at today's spot sulfur spreads. Now to do high sulfur versus low sulfur, we have to really look to the European market. In the European market, you can see that the premium for low sulfur over high sulfur is pretty negligible. It's been averaging about 64 cents a barrel over the prior 20 days. And the reason for that is there's still an ample market for high sulfur fuel oil. So that's what it looks like today. These two are literally on top of each other. Let me now take you out to 2020. These are the future prices for 2020, and you can see the spreads are pretty enormous. They've widened out to over $16 a barrel. They started fairly narrow and had 2 step downs in terms of widening. The first step down was when IMO made the initial announcement that, hey, we are going to do that, and they made the announcement in the fall of 2016. The second step down was actually earlier this year in Q1 when they said, look, we're going to be a stickler for non-compliant fuels and banned vessels. So they kind of laid down the law. They're going to be a stickler, but in reality, that's probably going to be hard to enforce. So when you look at these spreads, and you say, let's take these spreads and run them through a reasonable pro forma, what do we end up with? Well, desulfurization costs between $4 and $8 million per 1,000 barrels per day of desulfurization capacity, and the OPEX is between $1 and $1.50 a barrel. And that returns the 57% over a 20-year life project. Now, what's the key assumption to get to 57%? We're assuming year one is at the $16 spread, which is current market. Year two, which is 2021, the futures market spread isn't $16, it's about $14. And then we're assuming by year four, it goes all the way down to the $3 equilibrium. The $3 is the equilibrium price to put in a desulfurization unit and return 8% unlevered pre-tax. So we're going to have a step down from $14 down to $3 over the next 2 years. So if you do that forward curve, you get a reasonable assumption of about a 57% IRR. Now let's talk about what happens in the interim. There's going to be some waivers on high sulfur fuel oil. Some of it will be burned in the power markets, but what it's really going to do is it's going to come here during that interim with our complexity. This is the Nelson Complexity Index for the world's refineries. You can see that the United States and North America in general, we're coming in at a Nelson complexity of about 10. What's this complexity index telling us? These are the refineries that can consume as a feedstock almost anything, from the extreme light to the extreme heavy, the high sulfur to the low sulfur. The rest of the world's refineries don't have that capacity, and so that's coming here, and it's actually going to substitute for crude oil as an input. Now, there's something that's kind of a side benefit. I think that substitution will actually enable our refineries to use more ultralight crude oil, very light crude oil, even condensate as a feedstock blended with it, burnt crude, because it could lift the consumption of Eagleford, for example, and this could actually reduce exports of that oil as a blend stock. But that's really a second order effect. The first order is I see feedstock prices crashing. The crack spread outlook for this time frame for U.S. complex refineries, I think is going to be very, very good. Let me just close out with the takeaways once again. I don't think there's going to be 100% compliance, and I don't think the penalties are going to be onerous for failure to comply in the early part. The second is, if there is a major speed bump, I think it'll be retraded or renegotiated. The third is, these refinery projects are well underway. Sure they are. It's a 57% return order of magnitude. The fourth is, if they do come on late, I think this is less about soaring crude prices, more on tanking feedstock prices. If I'm a U.S. refiner, I'd be almost giddy about this. And then the fifth thing is, I look for these high sulfur spreads to equilibrate at about $3 per barrel versus about 50 to 60 cents a barrel. For this and much more information on how we got there, please visit us at cEntellect.com.